Hello and welcome to my channel. My name is Yomo Henry. If you're a regular visitor to this channel, I want to say thank you for always signing in. And if this is the first time you're signing into my channel, please remember to subscribe on the button. And I'm glad to tell you that you will learn a whole lot from this video. Now, today's video, I will be talking about the different kinds of traders that we have in the boom and crash market. The different kinds of traders that we have in the boom and crash market. And this video is a follow-up from the video best time frame for boom and crash traders. Remember, in that video I did promise that I'll talk about the different kinds of traders we have in the boom and crash market, and here is the video. So if you're ready, grab your pen and your paper and let's start. Now, to understand the different kinds of traders we have in the boom and the crash market, I need you to first understand that depending on the kind of trader that you are, the first and the most important thing you need to know is what I call time frame combinations. Time frame combinations. First, I said that time frames are specific periods in which price is segmented into. Specific periods in which price is segmented into. Now, I said time frames are what? Said are divided into two: the higher time frame and the lower time frame. Now, and these higher time frames are what we use for what? Analysis, and the lower time frames are what we use for what? Entries and exit. Now, depending on the time frame of focus, a trader can be said to be any of the following. A trader can be said to be what? A position trader, a swing trader, a day trader, a scalper. Now, what is the essence of all this? The essence of all this is for you to know that even when you are a boom and crash trader, you need to know the time frame of focus. You need to know your time frame of focus. Now, I'm going to take us to the chart right now, and I want us to pay close attention to what I'm going to show us. Now, if you're a position trader, according to my article today, you're supposed to be what? You're supposed to focus on the monthly time frame, which is what we have here. The monthly time frame, which is what we have here. This is the monthly time frame. Okay, monthly, weekly, and what? Daily. This is your what? The time frame of focus. But if you're what? If you are a swing trader, the time frame of focus is what? Weekly, daily, and weekly, daily, and what? Hourly. It's rather unfortunate that we don't have 8 hours here. Reason being that today I'm not using TradingView implementation. The reason for that is because if you're using TradingView implementation, you don't have the monthly time frame there. Now, but if you are a day trader, your time frame of focus is what? Daily, hourly, and what? 30 minutes. And if you are a scalper, for so many people that are, the time frame of focus is just what? 4 hours, 1 hour, 15 minutes, and possibly 15 minutes. Now, the reason why that is so is because different kinds of traders have different what? Time frames in which they focus on. Different kinds of traders have different time frames in which they focus on. And if that is the case, I decided to use Boom 1000 as what? As my market of interest today. So I'm gonna take this to possibly the daily time frame. I'm gonna squeeze it. I'd like us to look at that chart. Okay, looking at the chart. Okay, let me keep it at the weekly. Now, looking at that chart on the weekly time frame, any trader can see that this market is purely on what? An uptrend, because it is what? It has given us what? Higher highs and higher lows. These are higher low, higher low, higher high, higher high, higher low, higher high, higher low, and then what? A higher high. Okay, so having known this, position traders will just look at, okay, this is an uptrend, so what am I supposed to do? We are supposed to take our what? Our trades on what? That time frame. Now, since the monthly is their time frame of interest. They'll break down the analysis to possibly the daily for what? Entry and exit. And in some cases, what do? They draw trend lines. They draw trend lines. And sometimes most of them don't even draw trend lines. They trade what I call zones. Alright, this is what I mean. So just look for a rectangle. Alright, this is a zone. Alright, and then I look for another one. And then this one, a zone. So they wait for the market to get to zones before they what? Before they take their trades. For some of them they use Fibonacci, for some of them they use other trading styles. Alright. But if you are a swing trader that your focus is from the weekly, you get to realize that on the weekly time frame we have actually a structural high, which shows higher highs and higher lows. But then we have what? A pullback. For position traders and and swing traders, this pullback may not really be a problem for them. The reason being that their trade lasts a minimum of weeks. For swing traders, a minimum of 1 to 2 days. So this may not really be this little pullback may not really be a factor of consideration. All right, because the actual direction of the market, according to my analysis of who a position trader and who a weekly trader is that the market is still on an uptrend. Why? Until this higher low is broken. When this higher low is taken out, this is what I mean. When this higher low is taken out, then we can successfully say that what? The market is on what? A downtrend. But until then, this is just a pullback. However, for day traders that start their trading with the daily time frame and then they break it down to H4, let's look at this. This is H4. We can begin to see structural highs and low. This is our lower high, lower low, lower high, and then what? A lower low, which is on the same level with this. And then the market went back to that same level and dropped to this low, and then gave us a little range and then dropped to this. All right. So having known this, for some day traders, what would they have done? Even though the market is on an uptrend, they would have shorted this one, this pullback. The whole of this being the pullback would have been a focus of interest for them to do what? To short the market and make their money. Now for scalpers that focus from the hourly, they start from the hourly to focus. Let's just say right now we're on H4. So let's break down analysis to H1. You can get to see that the market has been what? It looks more like a range, but actually this is what we call volatile downtrend. This is what we call volatile downtrend. It's a kind of downtrend that might hit your stop loss at any point. And if you're not really a patient trader or a new trader, I don't advise you to take this kind of trading trend. Yeah, it's a trend, but it's a kind of volatile trend, because if you look at it, the market dropped and then rallied and then dropped, and then what? If somebody puts this place as a stop loss, the market will definitely take out that stop loss and then still come back and then went back up and then dropped again and then rally. So this is for professional traders only. It's not for newbies. So if you know that you are a newbie, try as much as you can to avoid what? Volatile trading market. You will not like it. You will not like it. So look for a real trend that is not volatile, and then you'll be happy with your life. All right. So for scalpers that begin the analysis from the hourly and they break it down to M15, this would have been what? A downtrend for them to just ride on. And to assist them better, they would have brought in what we call indicators. Example would have been a moving average or a Bollinger Band. Okay, but I've just brought in a moving average. Let's just say period, permit me to use period 20, and then let me make the pixel a bit better. Okay, so looking at it on F15, okay, this is a little bit better. Scalper could have at least taken a chance on this trade, especially from this zone here, from this point here. But I've just said, okay, it's so glaring that the candles are now what? The candles are now below the moving averages. So you will now what? Ride the trend from here down. Use this point as an entry down. Use this as another entry down. And now that the market has broken, gone above the trend, the moving average, it's now going up. All right. So this is just a video. Depending on the kind of trader that you are, I want you to know that the boom and crash market has made room for you to have the best. If you're a position trader, focus more on the monthly time frame. And yes, I wanted to talk about this. The reason why we are having that pullback is just because of this candle. This candle here. This is what we call rejection pin bar. So it is a bearish signal. By next week, I should make a video on boom and crash candlestick patterns. I'd like you to stay tuned and then come and then watch it. Now, this singular candle is the reason why we have the pullback, and this was the effect of last week's bearish interruption of the price. The bears came in and pushed the price downwards. And now what's going to happen here? There's only one thing that's going to happen, that this candle here was as a result of what? This. And if I should highlight it for you to have a good look at it, you'll be amazed at what understanding candlesticks can do for you. All right, let's just have a look at that in a jiffy. So let's break it down to the daily. You'll be amazed. Now have a look at that. Can you see the whole of that? So our structural highs and lows become more what? Peculiar. Let me take this away so that you can have a look. Our structural highs and lows become what? More peculiar, where this gave us a felt swing, this gave us a lower high, a lower low, a lower high, a lower low, and then it came back to that same lower high and then dropped massively. So if you're a swing trader, this is for you. This candle would have been of great indication about the trend of the market. And if this candle successfully forms and continues to run down, I mean this monthly candle runs down to the higher low, I can tell you from my heart that the market most likely may reverse, because it will form a candlestick that we call morning star. All right, if you're a swing trader, now this looked like a piercing line kind of candlestick pattern. I mean these two candlestick patterns here, these two here, looks like a piercing line kind of candlestick pattern, which for some traders they would have used that as a signal for what? For their trade. However, for scalpers, they would have fallen back to our hourly and our what? Minute time frame for what? For either the price structure or for the use of indicators like moving averages. Now, if this video has been of great interest to you, I want you to subscribe while I run through the summary again. Position traders focus on monthly, weekly, and daily. The monthly is a trend, the daily is an entry and exit. The swing traders focus on the weekly and the hourlies. The traders focus on the daily and the minutes, and the scalpers focus on the hour and the minute. What are the advantages of trading the time frame combination successfully? Number one, it enables you as a trader to know what the price is doing in a specific time frame, like we observed here in the monthly. A position trader saw this signal, and this gave him what? A confidence to what? To know that the market will definitely run on what? A pullback. Now, before this came to pass, somebody that might have been scalping And I've been wondering what the market is really doing, because the general trend of the market is what? An uptrend. But with what? A good knowledge of the specific time frame, like the monthly that gave us what? This candle rejection that we are seeing, this candle here. It helps us to know what the price is doing. Number two, it helps traders to have precise period of analysis, entries and exits. Okay, like we saw this in the monthly. What were we supposed to do in the daily? We were supposed to look out for what? Where we will have failed swing highs and swing lows. And where did that happen? This was a failed swing because it didn't get to this high. This was a failed swing. It didn't get to this high. It didn't get back to this high. So it fell there. And then what happened? The price dropped and then moved up and dropped and moved up and then what? Dropped. So knowing that helps us to know what? To stay precisely with what? Our time frame of what? Interest. So you don't have the room to compete with another person because you have your own time frame period of analysis, entries and exits. Number three, it helps a trader to avoid what I call fear of missing out. What do I mean by that? Fear of missing out. Okay. For some people that are scalpers, actually, I've discovered that when they take a trade and then they close it and the market is still moving their way, they want to rush back in. The simple truth is that if you're a scalper, just stay with your time frame of interest and develop your strategy there. There is no point running helter skelter, running from one market to the other. Just stay there and develop your what? The strategy. Number four, it helps a trader to know his or her limits and become contented. I just explained that point. Now, if you know this video has been of great and immense help to you and has added to your knowledge, subscribe and turn on the notification button. You can click on the like button. Let me know how you feel. You can drop your comments on the comment section. And thank you for watching. Thank you for watching and thank you for watching. God bless you.